Good morning from New York. Good afternoon to those of you in Doha, and good evening to all our friends dialing in from Asia. And welcome to today's roundtable entitled Pandemic Investment Resilience, Traditional versus Emerging Markets. My name is Damian Sassower. I'm the Chief Emerging Market Fixed Income Strategist for Bloomberg Intelligence, and I will be your moderator for today's panel. Thanks for joining us. We have an extraordinary lineup of industry luminaries and only 45 minutes to chat. So let's dispense with the formalities and get right into it. Sam Finkelstein, co-head of fixed income and head of emerging markets for Goldman Sachs Asset Management. Thank you for joining us. Resilience is really all a matter of perspective. Yes, economies in emerging markets have exhibited great resilience. We talked about reserves, remittances, even growth to some extent, but take your pick. What does resilience mean to you, especially in emerging markets?
When I think about resilience, it's really a matter of an economy, policymakers, and markets to cope with a shock. And the 2020 COVID shock was really a shock that had major, profound implications. It's unprecedented, at least in my lifetime of investing. And what we witnessed is different countries reacted differently. I think one thing that's clear when you think about emerging markets, it's really a motley crew. And when we think about the North Asian economies, their ability to control the virus and lock down was certainly better than the West, where there's more openness and mobility. But one could also argue that their focus on rolling out the vaccine has been lower and slower and is now having implications on economic activity. Another component of resilience is, what do policymakers do in response? And whether you're a developed or an EM country, there's really two levers. There's fiscal and there's monetary. And I would argue from a debt investor's perspective, the lack of defaults in emerging markets were not necessarily because of endogenous policies, but very strong monetary stimulus from the developed world, in particular the Fed, that really helped all capital and debt markets. But I think it's also important to look at the long-term implications for emerging markets. What is the scarring that's happening as a result of the pandemic? And I think about scarring really on two fronts. One is just the fiscal impact. And so debt to GDP in just about every country has gone up, some more than others. Brazil and South Africa, two countries where debt has risen. And this does have implications. What are the implications of higher debt? First, there's a larger interest rate burden. Maybe there's going to be future austerity to pay for this higher debt. And it puts countries on a more vulnerable backdrop versus those that started the pandemic with low levels of debt. And the other type of scarring that impacts growth, or when we think about growth, it's ultimately capital and labor. And so the pandemic has impacted the broad populations in the labor force. We don't quite know what labor participation will be in different countries. We don't know the extent of damage to the youth in the education, as many have been out of school. And so I think it is fair to conclude that, growth, will be slower as a result of the pandemic, but different countries with different responses. And thankfully, at least from a market's perspective, global liquidity was ripe and rampant, which certainly helped the functioning of financial markets.
No, that's amazing. We agree completely. Pablo, I'd love to get your thoughts as well. Pablo Duran Steinman, portfolio manager of Soros Fund Management, from the perspective of an unconstrained investor seeking to maximize their risk-adjusted returns, how do you approach emerging markets in this post-pandemic world?
It's a great question. So I think in hindsight, one of the strengths of emerging markets, I think during the peak of the crisis, my impression was that on average, we went into this crisis with somewhat higher than average real rates. From a macro investor perspective, that's something that is always relevant to assess the type of impact that emerging market assets will have. I would say that whether it was coincident or by design, this time emerging markets did benefit to have a little bit higher than average real rates into this crisis. I would say, second point, very important, the policy response in terms of fiscal. If you look at, you compare to the global financial crisis and compared to what policymakers did during COVID, it's unprecedented, the speed and the way that they adopted. And whether this ultimately proves to be the right strategy long-term, because we definitely have some challenges going forward, definitely gave emerging market economies time to adapt to this shock. I think that's the most important thing, and I think goes in hand with what Sam was saying, that we have not seen a lot of default, and this sometimes is just a result of these shock absorbers that policymakers adopt. But to me, one thing that is interesting is that given the concentrated nature of the reopen, especially in major economies like US, obviously China, and Europe now, the strength of the commodity cycle is giving a really relevant tailwind to emerging markets. And here is where I answer your question, because resilient to me in emerging markets mostly driven right now, in my opinion, by the external account aspect of these economies. If you look at a set of emerging market economies, I generally focus mostly on the majors, but most of the current account projections, at least the nowcast that we track, are outpacing the IMF projection for this year. And anyone that has been around in emerging markets multiple times for multiple crises realize that when you remove this sudden shock risk, emerging markets on average, given the development of the institutional framework in many of these places, fare much better. And I think this is the key for me going forward. As an investor, when I intersect this external account improvement, some valuation components in certain places, like, for example, Russia or Brazil, that come to mind, again, I focus mostly on the majors, and I come out with the conclusion that, if policymakers now unwind some of these policies like we're seeing on the monetary side, these countries have a really good chance to, let's say, convert towards more normal levels of asset valuation. And that obviously benefits the interest from, first, focus the interest from macro investors like me, but also benefits the asset valuations because of this inflows into these emerging market countries.
Fascinating. So interesting. I mean, that convergence of EM to DM, we've been hearing about it for some time, but with rates at current levels, we're closer to it than anyone really realizes here, I think. I mean, Stephen, I wonder if we could pivot a bit and talk about equity markets. Yeah, I mean, how have local emerging equity markets been impacted by the pandemic? What role, in your opinion, do they play within, a global institutional portfolio? I mean, we all know about emerging market equities. We all know the performance has been largely driven by Asia, high tech, and growth. But I mean, should we be looking at other sectors, other countries? Is there a pivot to be had here?
I think so. You heard from Sam and from Pablo. I think the relevance and the resiliency. If you'd asked me at the start of the year, would Mongolia be the best performing market in the emerging markets, I would have been slightly surprised, but it is. And I think from an equity perspective, we've had so many impacts into the equity market. You heard from Pablo about commodity cycle underway. What is critical here is that the GDP differential remains very much in favor of emerging markets. It's narrowed materially. That should expand in 2022. You alluded to there, and I think extraordinarily relevant, some of the technology advantages. However, interference is playing its part. We can see today the evolution of what's happening in crypto as China examines the relevance of that asset class in the market and invokes its imposition into that. However, the emerging markets from a liquidity perspective continue to grow and scale. And what is enormously relevant is the average daily volume in markets like China is now larger than Europe. So you have liquidity in these markets that I think is critically important. Emerging market credit's grown rapidly in the last decade. It's now larger than US high yield. Emerging market sovereign credit has almost tripled in size since 2009. And EM corporate credit is now just below 6 times the size it was back then. I think you've seen a growth in the materiality and relevance of the asset class, and that is providing part of the resilience here that I think is critically important. I think with the semiconductor cycle and the examination of the semiconductor cycle, you would have imagined Taiwan to have come under pressure. It hasn't, and has performed eloquently well. So I think from a resilience perspective, it's demonstrating resilient behavior. We shouldn't forget ultimately that emerging markets broadly is a huge composite here. It's most of the Earth's surface, it's most of its population, it's close to 60% of its economy, and it's only 17% of its financial market. In fact, emerging market equity is only 7% of its financial market. So I think not only is resilience being exhibited here, but you also have, from an investor's perspective, a myriad of different places that are exhibiting liquidity, both on the entrance and on the exit. So I think it's a hugely interesting year within emerging market equities and in emerging market credit.
Well, I think that's opened the door perfectly for me to kind of pivot over to you, Russell. I mean, Russell Chweidan, CEO, Bank of China International, we all know that China's inclusion in, many of the broad bond indices and the MSCI, I mean, it's only growing in terms of its importance from a investor standpoint. I wonder if you could briefly describe for us the opportunity set as you see it in this post-pandemic world, and perhaps even focus a little bit on this ongoing evolution of Chinese credit markets in lieu of what's going on out there today.
Sure. So I think just picking up on a couple of points we've had before. I think, Sam, you mentioned a motley crew that makes up the emerging markets, and it's never truer than now. The world's only major economy to grow, of course, was China during 2020, and that reflects a benefit of a different political system, frankly, that allowed for drastic action that was much harder to do for the developed economies. Growing from there's also this concept that there's local cash backing the resilience of the market as well. The middle and higher wealth owners in emerging economies, and in China especially, are large investors in both the credit and equity markets. And we've seen that flow of funds from them, of course, very much helped by the Fed's injection of cash into markets generally, which helps everyone. And emerging markets always gets a nice updraft when that does happen. We've seen, a dramatic change to China international debt over the last 10 years, with the growth of a major high yield market, which has been by and large a very good performer, but with the right number of potholes for investors to fall into if they were unfortunate, if they didn't have the right expertise there. And I think we see a good amount of private money still going into that market, but more institutional as well. Clearly, in recent months, we've had two of our biggest Chinese credits been in the news, whether that's Evergrande and their issues with their bank that they own a stake in, or whether it's China Huarong, where there's concerns over past misdeeds by the chairman and therefore the quality of their balance sheet and how we go about repairing that balance sheet without upsetting international investors too much. So there are certainly challenges ahead, but I look at if you're looking at market performance, certainly over short to medium term, so much of it is more about the flow of cash than the fundamentals a lot of the time. In China's case, the fundamentals are beneficial as well, but across emerging markets, we have that benefit of sufficient cash chasing an insufficient amount of assets still.
Even after all, I mean, it's just quite unbelievable. I mean, the amount of stimulus that's been injected, and we'll go back to the Fed in a minute. But while we're on Asia, Alicia Garcia Herrero, Chief Economist for Asia Pacific, Natixis. Let's take a step back. Let's look at the broader Asian region. Let's look at Southeast Asia. Let's look at India, Indonesia, the Philippines, Malaysia. What can we expect? I mean, how is the vaccine take up? What are your growth forecasts? Are there inflationary pressures? Are they real? I mean, what are you seeing on the ground in Asia?
Thanks very much. Well, this has been extremely interesting. I think we all share this view of first the structural push towards CM, especially Asia, because if we talk about size, that's where the action really is. We also hear about resilience as a key factor to explain what we saw since March 2020. But again, since March. And why March? Because the Fed was there. So I think a lot of what we see is still externally driven. If you ask me, and I count the reforms that have taken place in Asia or elsewhere, actually, in the EM space, as a consequence of COVID, i.e., as a way to prepare for the scars. There's no such thing. I can tell, and that's important to realize what might happen. I don't think this is across the board. So there's countries that are doing more. We had, of course, more opening up from China's side, especially on the financial sector. But we had a deal with RCEP, with Europe, comprehensive agreement on investment. I mean, a number of things going on. This isn't the case, though, of the rest of Asia. We need to realize that. There's a little bit of course, RCEP is a pan-Asian thing, but it is kind of pushed by China. I think if you look at India, kind of staying aside, self-reliance being the mantra, you can tell that for a world that is going to reopen, hopefully it's going to reopen, you don't want to be on the side of those that, yes, no current account deficit yet, I fully agree, but at some point, if growth comes back, you will. And you might not have the resilience from those that foreign direct investment coming in to support that. So I think it's important to kind of pinpoint which countries are still moving on their own, not just because of global liquidity. And I would argue that India isn't there yet. Hopefully it will, but not yet. Indonesia isn't there yet either. They did a little bit on labor reform, very minor. So those countries that look good because, of course, their fundamentals have improved. They weren't growing. I mean, for God's sake, their current account indeed improved. But what will happen next? So that's where investors want to look. And I do agree, though, that the flow is there. That there will still be structural flows in because these countries are bigger and bigger. But within that framework, we will see a little bit of a sudden fear, when the Fed tapers and who is out there when the ebb, of liquidity comes down, who is naked, and some will be. I would end by saying that in Asia less than elsewhere. You still look at debt dynamics. Generally, especially in Indonesia, is still low. So it's more about the liquidity issue. Can you change your forex and leave if you need to, and that would be it. And just to end on the smaller countries, because we never talk about them. I think for them, it's all about how quickly they will open. And there I come to your vaccine issue. Some countries are very small, compared to the big giants, and are still so far behind vaccination. And they depend so much on either tourism or, this for me is worrisome for the region. So they've locked in huge, very strict quarantine rules, but they can't get out of that without vaccination. So in that regard, Asia in a way is ironically behind on something they need very much for the small country type scenario. So I would be slightly negative on those for the reasons I just mentioned. And this includes Thailand, Malaysia, Philippines, by the way, as well. So yeah, slightly negative for that reason. Thank you.
Interesting. Well, let's switch regions here and pivot back to the EMEA region and Khush, Senior Vice President for International Development at the U.S. Chamber of Commerce. I know your focus is in the Middle East now, but you spent an awful lot of time in Turkey, and we've seen quite a bit of activity there as well. I'd love to just hear your thoughts from the perspective of an offshore investor looking to access these markets, not necessarily via the public markets, via the private markets, via infrastructure. What's the approach you would recommend them taking in this post-pandemic environment? How can they achieve success? How can they meet their return on investments, their hurdles? And what sort of time horizon should an investor expect when they're investing into the region?
So, I think that take Turkey as an example, you take the Gulf countries, they are able to, Turkey's vaccinating 1.5 million people a day at the current rate. So in as much as there was a slow start relative to vaccines versus the US or Europe, you're seeing that pace now, move forward. I would recommend that investors look at opportunities, particularly in infrastructure and healthcare and areas such as digital health. But I think we will see the investments in infrastructure continue. Investors should look at it on a project-by-project basis. each project being looked at for its own merits. But it's important to note that as these emerging markets come out of the pandemic, I think that particularly in the EMA region, you will see a refocus and hopefully in a positive sense an acceleration of structural economic reforms. Turkey is a good example of a country that could do structural economic reforms and move forward. Let's also not forget, as the world comes back to business, there will be an increase in demand for traditional and green energy. But again, there will be an increase in demand for oil and gas. And many of these markets will therefore, pick up with that.
Interesting. Well, let's pivot over to you, Dr. Kayrat Kalimbatov, Chairman for the Agency of Strategic Planning in Kazakhstan. It's interesting because, obviously a lot of economies operating out along the frontier have managed through this pandemic quite well. Remittances haven't really fallen off the way they once did. Certainly an oil producer like Kazakhstan, has done very well just in terms of building its reserve base and kind of, stabilizing its fundamental situation. But I wonder, when investors are looking to invest onshore domestically, what are the real, challenges that you see them facing? What are the real risks? And, obviously, the tenge is a less liquid currency than some others, but, how do investors look at currency risk? How do they perceive it? How do they look to manage it when they're investing onshore?
So first of all, I would like to join to the previous speakers that I think that the reason that the emerging markets are doing well, it's due to the commodities cycle. So we will enjoy the good prices for oil and gas. So I do believe that it's a significant reason. And I also would like to follow the Stephen mentioned that the IMF projected that the growth of emerging markets would be 6.9% versus 5% in advanced economies. So this is kind of the reality. But I think that one of the reasons is not only the ability to adapt, let's say. We all remember the book Why Nations Fail, written by Jim McGlew and Robinson, who mentions that the institutions are very much important. And I think in some advanced economy, the rigidity of any legacy institutions are higher than in emerging markets. So let me also remind you the old Aesop's fable about the oak and the reed. And the oak snaps during the storm, while the reed bends to the wind and survives the calamity. So this is something which is, I think, very much important to understand what's going on in emerging markets. Very much similar to the different industries in the global economy. So the most technological and flexible, like fintech and entertainment, I think blooming even during the crisis. Some small examples of the successful cases in Kazakhstan. You probably know that the neobank Kaspi group was focused on the fintech development and made a successful IPO in London Stock Exchange, even during the COVID. And in Astana International Exchange. So we do believe that the reforms which we are doing in Kazakhstan and our anti-COVID strategy is quite, let's say, relevant to the current moment. So we are doing great job in terms of the anti-COVID strategy. And using this, our sovereign wealth fund, we've also brought to the economy 9% of GDP stimulus package, which is $15 billion. So I think that's allow us to be focused on the, let's say, investment climate and to bring new investors, which we think that should focus on infrastructure and also on new agriculture development. Having the access to China or Russia, I think it's a good opportunities for global investors to think about investment to Kazakhstan.
Fascinating, interesting. Yousuf al-Jaida, CEO for the Qatar Financial Center. Thank you for joining us so much, for being here today. Same kind of question. What are the greatest opportunities for investors looking to the Middle East? And, we just heard a little bit about the energy sector, but, Qatar is in that rare situation with natural gas and with its strategic advantage there and with its foresight and its technological prowess. I wonder if you could kind of, at least from my perspective, give me a sense of who are the primary sort of offshore risk takers looking to the Middle East region, to Qatar, and what are you telling them? How are you competing for that offshore capital and how are you doing it so successfully?
Yeah, thank you, Damon. I wanted to start by congratulating you on the amazing event of Bloomberg hosted in my home country, Qatar. So congratulations on that. But I want to echo all the speakers in terms of a expected strong post-COVID growth environment. I mean, there's definitely a strong case for a weaker dollar. You're looking at a ultra-low interest rate environment, lack of inflation across emerging markets. There's also strong probability of a dovish monetary policy to continue in the foreseeable future. And if you look at the valuations currently in emerging markets, there's a massive discount compared to developed markets. So I really echo that the post-COVID world for emerging markets are going to be very positive. When that starts, I think we're looking at maybe Q4 of this year. Crossing your fingers that there's not another breakout of another wave of some sort. But let me start by talking about the MENA region and the COVID situation. I mean, we got impacted just like everybody else in the globe. There was initially lockdowns and across the entire region in the MENA, including Qatar. There was 2 lockdowns in Qatar. Hotels were closed. There was restrictions in terms of travel. People were working from home at a maximum rate of 80% with only 20% at work. So it was a very delicate situation in the beginning. But I think the countries that reacted sooner, including Qatar, in terms of fiscal policy and macroeconomic policy, I think made it out earlier in terms of coming back to normalcy. If we look at the Qatar situation, for example, vaccinations currently are at almost 60% of population. We're looking at herd immunity by September. We're going at a 25,000 rate of vaccines per day. So hopefully by September, we're looking at a herd immunity situation in Qatar and where things go back to normal and all restrictions are lifted. In terms of the economy, we're very hopeful in the MENA. Qatar, the UAE, and a couple of other countries have probably come out of it earlier than others because of the fiscal policies and because of the vaccination rates. But just to give you a flavor on the fiscal policy that Qatar adopted early on, there was a 75 billion rial injection, which is equivalent to $20 billion of injection into basically the economy. 10 billion rials of that went into the stock market, 50 billion into the financial system in terms of repos, and there was 3 billion rials in debt lent out to small and medium enterprise companies who were given a 2-year grace period to pay back, which is supposed to be up by September. So, and that basically helped get back the economy back on track. With our massive plans, the upcoming World Cup 2022, which Qatar announced will be a fully vaccinated, first of its kind World Cup event. And hopefully, if that happens on time, and we're hoping that it will happen on time, we believe that our economy will probably start getting back to normal in Q4 of this year. We're also hopeful that with the $25 billion of investments in expansion of liquefied natural gas, which will put Qatar at the forefront once again, becoming the largest exporter of liquefied natural gas at 126 million tons per annum. Again, a $30 billion investment into expanding those facilities. This hopefully will put back the economy in positive territory, and we're looking at a very positive 2022, a positive GDP growth compared to 2020, which was negative at around 4.5%. So we're very hopeful. We're looking at big plans, and we're hoping that 2022 onwards will be positive for the entire region. Foreign direct investment is at the forefront of every country in the MENA strategy. Everybody's trying to attract foreign direct investment to diversify away from oil and gas. It's a difficult task, of course, but creating jobs and attracting foreign direct investments and continued government spending into local economies will hopefully help us become an investment destination along with other regional countries. Of course, there's a lot of competition in terms of FDI, but I think every country has something to offer. So we're very hopeful towards a positive post-COVID world, Damien.
Thank you, Yousuf. Now, I mean, most of you had mentioned the impact of external forces on asset valuations across the emerging market landscape, specifically those by the Fed. I mean, the Federal Reserve's pumped nearly $4 trillion into the financial system here in the U.S. via purchases of government and mortgage-backed securities. It's reduced rates to near zero. Obviously, memories of the 2013 taper tantrum, not so fond memories resonate loud and clear in all our minds. You know, Sam Finkelstein, I wonder if you could just opine for us, you know, when the Fed does decide to pull this flood of money from the market, do you expect to see another taper tantrum-like episode on emerging markets? Do you expect asset prices to react in the same way?
Great. Well, you know, listen, all financial assets are going to depend on liquidity. And last week we saw a material change, at least in the 2023 dots. And so a weaker form of flexible average inflation targeting from the Fed. And I would generally say the market reaction was short-lived. If anything, the big move in markets was a flattening of yield curves rather than an abrupt sell-off across, you know, all markets. And so to me, it is very much possible to have tapering without a tantrum. And I think the necessary ingredients behind that are firm global growth. In 2013, growth was not, extraordinary by any sense or means, and it needs to be well telegraphed. And Powell is very crisp and clear in his message, although the 2023 dots changed. That is in 2 years, and still the dots are below where the market is. And with respect to tapering, I think it will be gradual, and we'll probably have 4 or 5 months notice before they gradually reduce the balance sheet. Doesn't mean I'm an unabashed bull on markets, but I think we can have tapering without the tantrum. One other point I wanted to hit on, and I know Kairat and Khush both spoke about, structural reform with a note of optimism. Structural reform, is important. I'm a little bit less optimistic. And what I would generally say is, in response to a pandemic, there was all policymakers, emerging markets and developed markets, it was firefighting. A $300 check in the U.S. is not structural reform. That's ensuring your population can eat. And if I look at Latin America, a general move towards the left. And you have to think about the politics of structural reform. And we can look at Chile, and 2 years ago, there was violent protests because of a 4-cent rise in the price of a metro ticket. And I think COVID has made the rich richer and the poor poorer. And I think there's more of a politics of redistribution than a politics of structural reform, which will lead to higher sustainable rates of growth. So sorry to be pessimistic, but just wanted to challenge, that positive. That's a generalization rather than every specific country.
Well, no, thank you for that. And look, I mean, I think it's time to tear up the script. I mean, Pablo, look, we mentioned previously, a lot of central banks have gone to novel policy instruments in order to stimulate their economies. For me, none stands out more than, the quant easing we've seen in places like, Indonesia, India, what have you. As, again, a buy-side practitioner, Pablo, I mean, does that give you a cause for concern that, central banks are, heavily positioned in many of the tenors, specifically at the long end of some of these curves? And do you think that does anything to the overall depth and liquidity of these markets and the willingness of externals such as yourself to want to participate in them without feeling they're getting a short end of the straw from the local market, so to speak?
That is a great question, and I think a challenging one to answer. Every country has unique market structure dynamics, which makes it hard to not to be too general. But my sense is that the process will be a function of how the Federal Reserve in the U.S. behaves. And the reason is, I think that all of these policies can be unwound mechanically, smoothly. but you need time. And the timeline is, in my view, set by generally the major central banks. In this case is the Federal Reserve. I think that it's possible that the unwind of the Federal Reserve unorthodox policy, the first part, can be done smoothly because, in my opinion, the timeline has not changed that much, despite that the dot, reflected maybe somewhat more hawkish path than the previous dots have, not versus the market. With this in mind, I think that one benefit that emerging markets will enjoy organically from this recovery is that by the time the Fed needs to take this action, and my personal view is that September they announced, they start the official process, and maybe December they actually announced the taper and started. By that time, I expect a synchronization of the recovery. Hopefully, COVID is behind. I'm somewhat concerned that there are, diversity of vaccines, and that it's clearly showing some difference how, the virus keeps spreading. For example, a great example is Chile, where they have a lot of Sinopharm vaccine, and we still have in Chile a lot of contagion. So that's something to keep an eye. But hopefully by December, the emerging market can recover in a synchronized fashion. And I think that generally it's the predominant force for emerging markets. In that case, the way I think about financial conditions, that is generally positive and supportive for financial conditions, may offset some of the withdrawal liquidity of the Federal Reserve, and that may allow the central banks of each of these countries to withdraw from these unorthodox policies in a smoother way. But again, it's important to understand the idiosyncratic dynamics of each of these markets, because I think each of them have different market structures.
Interesting. Stephen, in your role as Deputy Global Head of Markets at Barclays, I wonder if you could just share with me, the EM investor base, right? I mean, have you seen any change in it since the pandemic? Historically, it's been that traditional long-only 40-act manager, who's been kind of picking away at the risk in EM credit, or, potentially, reserve money kind of getting more involved at the FX level, so to speak. In your opinion, you're seeing investors come to your bank every single day, participating in deals, participating in all sorts of financing. I'm wondering, has the marginal risk taker in emerging markets changed at all? And going forward, how do you kind of see it evolving? Like, who are the kind of players that are more likely to get involved in the forward-looking beta environment?
I think you retain a core set of investors in emerging markets. You alluded to a number there. What is changing, of course, is the hunt for yield is everywhere. That's leading different investors into places that they would not normally be involved in. So that's number one. Number two, I think the shape of investors is changing. A lot of the large platforms that have existed, who have been relatively mono asset class determining or marginally multi-asset class determining, are expanding their asset class remit. So I think you're seeing not only a continuum of the existing investors, this huge focus on hunt for yield. I think some of the commentary here is leading you to a different set of investors anyway, which is, historically, a number of these economies have been and still are driven by a commodity cycle. What you're seeing is a very different set of industries emerge, which not only is dispersing the credit risk, but it's exposing those economies to a different set of investors looking for innovation, looking for technological change, looking for tourism. And I think, even in a post-pandemic world, that's going to become more and more critical. So I think the shape of investors is somewhat static, but at the margin, it is definitely beginning to evolve.
Excellent. Well, I mean, look, we're getting to the end here, but Russell, I have to ask you, the COVID-19 shock, it's been like anything we've witnessed in the modern era of capital markets. I think we can all agree we've never seen anything like it. What economic and financial vulnerabilities were exposed by this episode, but more importantly, what really surprised you? You've seen a lot of things. If you had to look back over the last year, what stands out as having really surprised you? You just didn't see this one coming.
Well, I guess as we went into 2020, we looked at things, and I remember thinking I had that that sense that everything was looking a bit too good, frankly. Everyone was much more relaxed about risk and was getting well paid for taking it. And as is always the way, it's never the risk that you can see in front of you. It's always that velociraptor behind the bush that comes out and eats you, and you had no idea he was there. If you look at Jurassic Park as an idea behind it, and really this was it in terms of the sudden drop of liquidity, because that's really what drove the market the way it did. The sudden fear that I wouldn't have money to pay bills, that businesses wouldn't be there that I've relied on as being stalwarts. That was the real panic ahead of the Fed, I suppose. And what's remarkable isn't so much that happened, because let's face it, it's not new. 1997 was all about currencies that were never going to depreciate until they halved. There have been various taper tantrums and other tantrums along the way. What was new for me was just how quickly we recovered, just how quickly confidence came back, and the ability to mobilize local capital was the thing that was very different this time. There was so much more local wealth that could go into these markets as well, which historically there hadn't been. It's really been about, if the foreigners pulled out, markets tanked, and it really became a huge problem. And now maybe they are foreigners, but they're foreigners from a lot nearer than Europe or the United States. Yeah. I mean, it's interesting when we talk about touristic type investors as well. One of the growths we've seen is Chinese credits in euros. And one of the reasons that market grew up wasn't because a lot of EM investors had euros to invest, and therefore it's a great place for it. It was what some friends of mine in big European IG funds were calling their tourist traps, which is they'd say, look, I've got 1 or 2% that I can go off index, and I can actually get some decent yield by taking a very highly rated Chinese corporate. And so you had people who wouldn't normally look at it coming in there. We had a similar thing a few years ago when Sinuk bought, the China National Oil Corporation bought Nixon in the States. And all of a sudden, a whole group of American investors suddenly discovered that they now understood more about Chinese oil companies. So getting the tourists in helped, but getting the local wealth mobilized, I think, was the transformational thing this time around.
Yeah, I would add I think the speed was unprecedented. That's the speed with which the virus spread across the globe. It's the speed with which markets sold off. It's the speed with which policymakers react. And it's also really the speed with which scientists developed a vaccine. Usually it's a 10-year cycle, and this was, in 12 months.
Alicia, I ask you the same question. What stands out to you? You look back over the last year, you look back over the course of the pandemic, what really surprised you? Oh, I think we lost a little bit of volume. I don't know if I'm the only one.
I can't hear.
Sorry, I'm here. Speed is a good one, but copycat approach is also a good one. I mean, you had countries that would afford a lockdown going for it, countries which couldn't afford a lockdown going up for it too. So I think what we've learned is that as we move into a new reality, we're going to have more virus, we're going to have endemic viruses, we're going to have climate change. I think countries are going to develop their own ways, their own solutions to what we have ahead. And there will be much clearer winners and losers. Now we had a little bit of a net of liquidity and everybody was fine to some extent. But I think that's going to change. And I'd like to say one more thing, that what really surprised me is that we ended up seeing things we never thought we would see. For example, nobody traveling. I mean, if Asia now, still today, is like you just can't believe what's happening. Yeah, these quarantine rules are draconian. So I think what could happen that we are not expecting is that in the same way as we stopped people from moving, we could stop capital from moving. And I worry about this very much because we've seen it all in a way in the course of the year. And why would this eventually happen? In the light of a very different tapering. I agree that that's not the baseline scenario. I agree that this time looks different, milder, no tantrum. But if there were to be, for whatever reason, the Fed just can't do it, or whatever, it just goes behind the curve, and it suddenly has to react to inflation. So many reasons. Then what about countries with high savings saying, sorry, these are for me. I'm not sharing in the same way as I'm not accepting vaccines from others, in the same way as I'm not allowing my tourists to go anywhere, So what about that? And that would be a very different scenario because you would see a lot of arbitrage, distortions, in the credit market, very different pricing. Unlikely, but scary.
So that's it. I think we've just about run out of time. I must apologize, Khush, Dr. Kalembatov, Yousuf. I wanted to ask you the very same question. I didn't do my job properly, but thank you, ladies and gentlemen, for your time, for your attention. Thank you to our panelists for sharing your thoughts and views here with us today. Keep well, stay safe, and keep moving forward. Thank you so much for joining. Bye now.
Thank you very much. Thank you.
Pleasure.
Bye-bye.
Thank you. Bye.